Good morning. Our lecture today is about capital budgeting technique. The main goal of any firm, as we said before, is to maximize owner's wealth. In order to achieve this goal, firms have to evaluate and select an investment project among number of projects in order to achieve this goal. So capital budgeting technique means the process of evaluating and selecting long-term investments that are consistent with the firm's goal of maximizing owner's wealth. Let's start with explanation for number of terminologies that will be used during our lecture. Number one, a capital expenditure and operating expenditure. What's the difference between capital and operating expenditures? A capital expenditure is an outlay of funds by the firm that's expected to produce benefits over a period of time greater than 1 year. While operating expenditure is an outlay of funds by the firm that's expected to produce benefits received within 1 year. So this is greater than 1 year and this is within 1 year. Okay. What's cost of capital? Cost of capital is the firm's cost of financing and is the minimum rate of return that a project must earn. So cost of capital can be defined as cost of financing or minimum rate of return that a project must earn in order to be able to increase the firm value. Capital budgeting process has 5 main steps. Number 1, proposal generation. In case of proposal generation, you have to prepare a proposal for each new investment project. And these proposals are going to be reviewed by finance person. Okay, so this is number 1. We have to prepare a proposal for each investment project and review each one of them. The review process will be the second step in the capital budgeting process. Review and analysis of the proposal. This step will be performed by financial managers. They are going to perform the review and the analysis in order to identify the merits of each investment project or each investment proposal. Then step number 3, decision making. After the review and analysis process, they have to take a decision about which project will be the most appropriate one. This is going to be depend on the dollar limits, the amount of money available in the firm, and the expected profit of each one of the projects. Okay. Number 4, implementation. After the selection of the best project, we have to start implementing this project. And finally, follow up. Results from the project should be monitored, and the actual cost and benefit should be compared with those that were expected before in case of review and analysis. And the corrective actions should be taken if there is any disturbances. Okay, so these are the main 5 steps for any capital budgeting process. Returning back to the basic concepts that will be used, what's the difference between independent project and mutually exclusive projects? Independent projects are projects whose cash flows are unrelated to one another. So the acceptance or the rejection of one of them will not affect the acceptance or the rejection of any other one. Okay? While mutually exclusive projects, They are projects that complete one another. So if you are going to take a decision concerning one of them, this will affect others. If you are going to reject or accept one of them, this will affect others. Okay? So this is the difference between independent and mutually exclusive projects. What's the difference between unlimited funds and capital rationing? Unlimited funds is the financial situation in which a firm is able to accept all independent projects that provide an acceptable return. So it's a situation in which the firm is able to accept all independent projects that provide an acceptable return. What about capital rationing? Is a financial situation in which a firm has only a fixed amount or fixed number of dollars available for capital expenditure, and numerous projects compete for these dollars. So this means that you have a fixed amount of money and you would like to use this money in order to implement number of projects. So these projects compete in order to take this fund. Expression number 3, accept reject versus ranking approach. Accept reject approach versus ranking approach. Accept reject approach is the evaluation of capital expenditure proposals to determine whether they meet the firm's minimum acceptance criteria or not. So it is an evaluation of capital expenditure. To determine whether they meet the minimum acceptance criteria. What about ranking approach? Ranking approach means ranking of capital expenditure projects on the basis of some predetermined measures, such as rate of return. So in case of accept or reject, you have to take a decision based on the minimum acceptance criteria, whether we are going to accept or reject this project. While with respect to ranking, we have a number of projects and we are going to rank them based on a predetermined measure. We have to determine which measure we are going to use. For example, we can use the rate of return. So we are going to rank them from the highest rate of return to the lowest one, or vice versa, or maybe based on the cost of capital, etc. Okay, let's start with an example about capital budgeting techniques in order to be able to apply the techniques that will be used in our lecture. Bennett Company is a medium-sized metal fabricator that is currently contemplating 2 projects. So this is a company, Bennett Company. Is going to study 2 different projects. Project A and Project B. Project A has an initial investment of $42,000, while Project B has an initial investment of $45,000. Both of them is gonna be operating for 5 years. Okay. The expected cash inflows for this firm, or the return from these projects within these 5 years, will be in case of Project A, it is 14,000 for year 1, 2, 3, and 4. And in case of Project B, it's 28,000, 12,000, 10,000, 10,000, and 10,000. So we can summarize it in a timeline just like this. This is for Project A, the initial investment in year 0, 1, 2, 3, 4, and 5. For year 0, it's 42,000, and then it's 14,000, 14,000, 14,000, 14,000, and 14,000. And for project 2, it's 45,000 for year 0, 28,000, 12,000, 10,000, 10,000, and finally 10,000. So this is the in and out cash flows for the 2 projects. The first method that can be used in order to identify which project is gonna be accepted or more profitable is the payback period. Payback period is the amount of time required for a firm to recover its initial investment its initial investment in a project as calculated from cash inflows. The length of the maximum acceptable payback period is determined by management. So this means that we have to compare 2 different time periods. Number 1, maximum acceptable payback period, which is going to be determined by the management, and the actual payback period, which is going to be calculated from the cash inflows. If the payback period is greater than maximum acceptable payback period, then reject the project, and if it is less than the maximum acceptable payback period, then accept the project. So say for example, if the management decide that the payback period accepted, the maximum acceptable payback period is 2 years and from the cash flows you have calculated the payback period to be 2.5 years, 2.5 years. So this means that the payback period is greater than the maximum acceptable payback period, and then the project will be rejected. Okay, returning back to our example. As we said with respect to project A, which is an annuity, the payback period will be calculated as its equal amount of payments going to be received each year, which is 14,000. So it's going to be easy to calculate the payback period as 24,000, which is the initial investment, divided by the 14,000. It will be 3. This means that the payback period in this case will be 3 years. In case of project number 2, it's a mixed stream of cash inflows. They are not equal to each other. So it's not gonna be calculated straightforward. But we have to get this for project A. These are the cash inflows and the cash outflow was 45,000. So in year 1 we are going to finance 28,000 out of the 45,000. So the remaining amount of money is 17,000. In year 2 it's 5,000. In year 3 we have to pay the 5,000 in addition to an extra amount of money, which is 5,000. So with respect to the last one, it's 5 divided by 10,000, it's half. So this means that the payback period will be year 1, year 2, and the half of year 3. So it's 2.5 years. So once again, we can calculate it as 28,000 in year 1 plus 12,000 in year 2. So this is 40,000. Okay, with respect to year 3, the remaining amount of money is 5,000. 5 divided by the inflows of this year. So it is half. So it will be 2.5 years. So it is 2 years plus 50% of year 3. So it's 2.5 years. So what are the main advantages and disadvantages of using payback period analysis? Number 1, the payback period is widely used by large firms to evaluate small projects and by small firms to evaluate most projects. So it is the most popular method that can be used. Why? Because of its simplicity. And number 2, it helps the firm in order to identify how quickly the firm recovers its initial investment, so this may help the firm in order to measure the risk of risk exposure. Usually firms use payback period as a decision criteria or a supplement to any other decision techniques. Okay, so this is the most two important advantages of using payback period. So what about the disadvantages of using payback period? The main or the major weakness of the payback period is that the appropriate payback period is actually we cannot determine what is the appropriate payback period. We have calculated that the payback period for project A is 3 years and for project B is 2.5 years. So what is the appropriate payback period? Is this good enough or not? So we cannot determine the appropriate payback period. Number two, it fails to take into account the time value of money. Actually, in the calculation of payback period, we take the value of money as it is without considering for the discount rate or inflation rate that may occur during these time periods. And the third weakness of payback, it fails to recognize cash flows that occur after the payback period. Let's take another example for payback period when the firm has to pay taxes. A firm is considering investing 20,000 to obtain a 5% in a rental property. The firm has to pay 25% tax bracket. To be acceptable, it's expected that the payback period should be less than 7 years. So this is the maximum acceptable payback period. If you know that this firm is going to receive between 4,000 to 6,000 per year. So what's the payback period from this investment? Number one, the first step is to calculate the annual after-tax cash flow. The income can be 4,000 or 6,000, so we have to calculate it twice. This is 1 minus tax rate multiplied by pre-tax cash flow. So it's 1 minus 0.25, which is the tax rate, multiplied by 4,000, so it's 3,000, And in case of number 2, it's 1 minus 0.25 multiplied by 6 thousandths, it's 4,500. So this means that the after-tax income ranges from 3,000 to 4,000. So we have to calculate it twice, the payback period twice. One for the 3,000, as the income can be 3,000, and the other one for the 4,000. So this is an equal annuity, okay? So the payback periods will be calculated as initial investment divided by after-tax cash flow. So for case number 1, it's 20,000 divided by 3,000, it's 6.67. And if income received is 4,500, it will be 20,000 divided by 4,500 is 4.44 years. So this means that the payback periods will be between 4.4 or 4.44 years and 6.67 years. Both of them is lower than the maximum payback period, maximum acceptable payback period, which is 7 years. So in this case, we are going to accept this investment project. The second technique that can be used is the net present value. Net present value is a sophisticated capital budgeting technique. It's calculated as subtracting a project's initial investment from its present value, from the present value of its cash flows. So net present value is calculated as summation from t equal 1 to n, cash flows in time t, discounted value divided by 1 plus r to the power t minus the initial investment. If net present value is greater than 0, then accept the project. If it is less than 0, then reject the project. If it's greater than 0, this means that the firm will earn a return greater than its cost of capital. Such action should increase the market value of the firm, and wealth of owners is going to increase, and then we achieve the main objective of the firm, which is increasing the wealth of owners. Example. We have to compare two different projects, Project A and Project B. The initial investment, actually it is the same examples that we have illustrated before, is 42,000 and 45,000, and this is 14. 28, 12, 10, 10, 10. The additional information that we have to know is that the cost of capital is 10%. What is the net present value? we have to calculate the discounted value for each item, given that R equals 10. So we have to refer to this equation. This is R, which is 10%, and this is the cash flows based on their values. So net present value is going to be calculated as 14,000 divided by 1 plus 0.1, this is to the power 1, plus 14,000 divided by 1.1 to the power 2, 14,000 divided by 1.1 to the power 3, etc. minus the initial investment, which is 42,000. So this is gonna be 53,071 minus 42,000. It will be 11,071. So this is the net present value for the first project. With respect to the second project, we have to do the same. Net present value is calculated as 28,000 divided by 1 plus 0.1 plus 12,000 divided by 1 plus 0.1 to the power 2 plus 10,000 minus the initial investment, which is 45,000. The present value for all inflows is 55,924 minus the initial investment, which is 45,000. It will be 10,924. So this is the net present value for the second project. Number 3. Number 3 is Profitability Index. Profitability Index is calculated as summation from t equal 1 to n, cash flows over time t, divided by 1 plus r to the power t, divided by the initial investment. If price index is greater than 1, then accept the project. If it is less than 1, reject the project. So with respect to the our previous example, profitability index for project A will be 53,071 divided by 42,000. It will be 1.26. So accept the project. With respect to project 2, is 55,924 divided by 45,000. It will be 1.24. So accept the project. And finally, and the last indicator, just we are going to know the rule without any calculation, okay, which is the internal rate of return. This is number 4. Internal rate of return is the discount rate that equates the net present value of an investment opportunity with $0. Or in other words, it's the rate of return that the firm will earn if its investment in the project if it invests in the project and receive the given cash inflows. So in this case, it's the internal rate of return if the net present value equal 0. So it's the same rule as the net present value, which is summation n t equal 1 cash flows for time t divided by 1 plus IRR all to the power t minus initial cash flows. This is equal 0. So in this case, we have to find the value of the internal rate of return that will achieve this equation, or that satisfy this equation, this condition. So in this case, the net present value, the present value of cash inflows will be equivalent to the initial cash flow. If internal rate of return is greater than cost of capital, then accept the project. If it is less than the cost of capital, then reject the project. This is the end of our lecture today. Thank you and see you next week.